Ladies and gentlemen, thank you for standing by and welcome to the Newcrest Mining 2020 half-year results conference call. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this conference is being recorded today, Thursday the 13th of February 2020. Now I hand the conference over to our first speaker today, Chris Maitland, Head of Investor Relations and Media. Thank you, and please go ahead, Chris.
Thank you. Good morning, everyone, and welcome today. With me today is our Managing Director and CEO, Sandeep Biswas, and our Finance Director and CFO, Jared Bond. Please note that if you wish to ask a question at the end of the presentation, just press star 1. Please take note of the company's disclaimers on this slide. As you may already be aware, Newcrest is a US dollar reporting entity, and all dollar references made in this presentation refer to US dollars unless otherwise stated. I'll now hand the call over to Sandeep.
Thanks, Chris, and good morning, everyone. So today, Jared and I will take you through our financial results for the first half of 2020. But first and most importantly, I'll spend a moment talking about the progress we've made on safety and sustainability this year. Then I'll provide an overview of our half-year results, followed by a review of the operational and financial performance of each of our operations. Jared will then discuss our financial results in more detail, after which I'll provide a summary of Newcrest's unique properties as a multi-decade gold copper miner and highlight the differences that help make us unique within the gold industry. The first half has seen another period free of fatalities or life-altering injuries, making it almost 4.5 years now. The total recordable injury frequency rate for the last 6 months looks like it's stabilised at 2.3 million per million man-hours worked. However, the December half data now includes Red Chris, which is a TRIFR significantly higher than other Newcrest sites. Putting Red Chris aside, Newcrest TRIFR for the year would have been 1.8, which is a significant improvement compared to this time last year and is at industry-leading levels. This improvement was driven by Cadia, Telfer and Lihir, all having fewer injuries in the period. Red Chris is a great opportunity for us to apply the Newcrest Safety Transformation Plan with the objective of achieving the same improvement in safety culture, controls and processes that's been delivered across other Newcrest sites. This will not happen overnight. We've made a strong start and our first steps have been well received by our people. The initial focus of our Safety Transformation Plan, as it was at all other Newcrest sites, is to engage with the workforce in the NewSafe program, building a safety culture from the bottom up. NewSafe has a leadership, coaching and behavioural component. Almost all the people leaders at Red Chris have completed the leadership component, and over the coming months, crew members will experience NewSafe leadership and commence the coaching and behavioural components of the program. I'm really encouraged by how positively the Red Chris workforce has embraced these changes and look forward to seeing a reduction in the number of injuries there. Like our commitment to safety, sustainability is core to the long-term success of Newcrest. We believe the business imperative is straightforward. Sustainable outcomes underpin successful operational outcomes and shareholder value creation. Last August, we announced a series of sustainability targets that reflect our values and give an insight into how we'll manage this area of our business. They include a greenhouse gas emissions intensity target, pricing carbon emissions into our capital investment decisions, a catchment-based approach to water management, and a target of no net loss of biodiversity values for new projects. Our aim is to relentlessly innovate how we operate and improve our energy efficiency, water management and environmental performance to ensure we remain a sustainable business for the long term. As also previously announced, we've committed to disclose our progress against the TCFD framework. This year, our public reporting will seek to include our progress against our emissions intensity target, how we apply our shadow carbon prices, and our approach to climate change governance. Longer term, to test our operating and financial resilience, we'll look to assess climate scenarios on our portfolio of assets. Operationally, Newcrest delivered gold production of 1.1 million ounces and 62,000 tonnes of copper at an all-in sustaining cost of $880 per ounce. Our first half production is typically lower than the second half as a result of our maintenance schedules at a number of our operations. From a growth perspective, the December half was a period in which we invested for the future. We successfully completed the acquisition of 70% of Red Chris, a mine in Canada with a potential Tier 1 ore body. We also increased our investment in Lundin Gold, the owner of Fruta del Norte, a Tier 1 mine in Ecuador. And we recently received some positive news in relation to Golpu, which I'll talk a little more about later. Finally, our exploration results in the first half were very pleasing. We announced some very promising exploration results from Havieron, located near our Telfer mine in Western Australia. These results extend the mineral footprint and signal the very real potential for renewal of our asset portfolio in the Paterson province. The grades we're seeing at Havieron are unique for this region, and we're excited to progress and accelerate our evaluation of this opportunity. Initial drill results at Red Chris have been very positive, with the identification of a new higher grade zone, which has expanded the mineralisation in the Gully zone. We've commenced the East Zone resource definition program with the intention of developing a new resource model incorporating both historical Imperial Metals results and 2019 Newcrest drilling data. I'll discuss the drilling results of both Havieron and Red Chris in greater detail later on. Our continuing strong financial position enabled the board to determine an interim fully franked dividend of 7.5 cents per share. We remain very focused on returns to shareholders and have a strong dividend policy that puts shareholders first. So even in a half year where we made a large investment in Red Chris, we've kept to our commitment and have declared an interim dividend. For the half, Cadia produced its 411,000 ounces of gold at an all-in sustaining cost of $167 per ounce, generating a free cash flow of $459 million. Copper production was 45,000 tonnes. This was another outstanding performance from Cadia. Golden ounces were lower than the prior period, primarily as a result of the extended downtime of the Concentrator 1 SAG mill. This occurred during the first quarter as a result of preventative maintenance. Lower gold grades compared to the prior period were also a factor. Cadia rebounded well in the second quarter with a standout performance, which culminated in the site achieving its second highest quarterly gold production result. You would also be aware that New South Wales has been in drought for a number of years now, with the last 2 years being the lowest on record. Our modelling shows that if calendar year 2020 was to be like the last 2 years, in other words, another 1 in 100 low rainfall year, then production may be impacted by the end of the calendar year. Of course, any rainfall amounts higher than this 1 percentile scenario progressively extends the date at which production might be impacted and eventually can eliminate this risk altogether. Based on current modelling, we don't anticipate any production impact if rainfall is at or above the 10th percentile of the historical average. However, we continue to pursue all sensible options to maximise our recycling rates and increase our access to alternative water sources in an effort to minimise this potential risk. We are encouraged by the recent wet weather in other parts of New South Wales and are keen to see how it may extend to the relevant catchment areas for the Orange District. Turning to Lihir, it produced 381,000 ounces of gold at an all-in sustaining cost of $1,154 per ounce in the first half. Compared to the prior period, Lihir's production was impacted by lower grade ore feed to the mill and a corresponding reduction in recovery rates. In addition, during the half, Lihir commenced transition to a biannual shutdown strategy aimed at improving equipment reliability and utilisation from FY21 onwards. I'll talk to this in more detail shortly. Lihir generated $84 million of positive free cash flow for the half, higher than the same time last year. And though we've advised Lihir's production will be around the bottom end of its guidance for FY20, we expect it to have a strong second half, which, if realised, would translate into a stronger half of free cash flow. On to Telfer. It had a tough first half and its performance was below my expectations. The site produced 182,000 ounces of gold and 7,000 tonnes of copper at an all-in sustaining cost of $1,380 per ounce. Early in the half year, Newcrest announced a change in the operating strategy for the site. That change involved reducing the operating rate to utilise around 1.4 of the site's two-train capacity, and at the same time targeting higher feed grade to improve its cash margin. Corrective action plans are being implemented to drive an improved performance at Telfer over the next 6 months. Whilst Telfer recorded a negative free cash flow of $22 million, revenue losses on the gold hedge book were $33 million. This means the underlying business was free cash flow positive in the half to the tune of $11 million. Gosowong produced 76,000 ounces of gold at an all-in sustaining cost of $1,261 per ounce in the first half, primarily reflecting substantially lower grade ore feed to the mill. Many of you will recall we were required to divest at least 26% of our interest in Gosowong, and we recently announced that we've agreed to divest our entire interest in Gosowong for $90 million. Once the conditions precedent have been satisfied, economic ownership of Gosowong transfers to the new owners with effect from 31st December 2019. I'd like to extend my sincere thanks to all our Gosowong employees who've contributed so much to the success of Gosowong and Newcrest over the past few decades. It's been a fabulous gold mine, and we wish the team there and its new owners every success for the future. We've been very focused on integrating Redcrest during the half. As I discussed earlier, our first priority is the implementation of Newcrest Safety Transformation Plan. We also recently announced our first drilling results from Redcrest, which I'll talk a bit more about later. For the period, our ownership in this half, our share of production of Redcrest was 11,000 ounces of gold and around 10,000 tonnes of copper at an all-in sustaining cost of around $2,600 per ounce. The high all-in sustaining cost, combined with working capital adjustments post-acquisition, has resulted in the site being free cash flow negative in the period. Our goal is to make the site free cash flow positive on an underlying basis. To achieve this, we're investing in the long-term future of Redcrest, which will involve a level of capital expenditure for a period to improve the site and its operational performance. At the same time, we'll continue to invest in drilling and studies to develop a block cave. We've also recently acquired the GJ copper-gold property adjacent to Redcrest, comprising approximately 35,000 hectares of prospective land. It sits on the same structural corridor as Redcrest, and we're pleased to expand our footprint in this prospective region. As I mentioned when we acquired Redcrest, we intended to apply a two-stage transformation to the operation. Stage 1, which has been our main priority since acquisition, will be to apply a Newcrest Edge transformation approach. This is about safely optimising the mine, plant and cost base to maximise its cash generation potential. Stage 2 will involve applying Newcrest leading technologies, including deep underground brownfield and greenfield exploration, block caving, coarse ore flotation and mass sensing and sorting. We appointed Mark Adams, previously our General Manager of Telfer, as the General Manager of Redcrest. Mark and his team have been busy over the last 150 days of our integration program, and I'm pleased with their performance on progressing the first stage of the transformation plan. We've begun to upgrade the camp and other working facilities such as the mobile equipment workshop. We completed the necessary tailings impoundment area construction on time as well. A pit optimisation study has been completed and shortly a fleet management system will be implemented. In order to improve recoveries, we installed the first concentric launders in the rougher circuit, completed a stacked cell pilot and a cleaner column concept study. Given the potential for a block cave development at Redcrest, one of our biggest successes during the period was the completion of 17,500 metres of drilling. Data from this drilling will be used in the block cave concept study, which is currently underway. I'll now pass over to Gerard, who will outline Newcrest's financial results for the half.
Thank you, Sandeep, and good morning, everyone. Newcrest continues to be in a strong financial position. During the half, we delivered an underlying profit of $280 million, up 18%, and a statutory profit of $236 million, which was in line with the first half of FY19. We continue to have a low-cost position relative to the industry and our gold major peers, with an all-in sustaining cost of $880 per ounce for the half. This resulted in an all-in sustaining cost margin of around $566 per ounce. EBITDA and EBIT margins were strong at 42% and 26% respectively. And all these margins were derived on an average realised gold price of around $1,446 per ounce for the period. As you know, the spot gold price has been well above that this calendar year. As Sandeep outlined, the December half was a story of investing in our future with $1.2 billion of investment expenditure. This includes progressing growth options like the Cadia expansion, our acquisitions of Red Chris and a further interest in Lundin Gold, as well as our significant exploration activity. Notwithstanding this, we ended the half with net debt of $1.365 billion and $691 million of cash on hand, positioning us well within our financial policy metrics. Gearing at the end of December was 15%, and our leverage ratio was a low 0.8 times. So we continue to have a strong balance sheet. In line with our dividend policy, the board has determined to pay an interim dividend, fully franked, of 7.5 cents per share. This is the same interim dividend amount as the previous 3 years and amounts to a payout ratio of 55% of adjusted free cash flow. As mentioned, statutory profit was $236 million, including significant items of $44 million, which represents the write-down of Gosowong following its classification as held for sale. Underlying profit of $280 million for the half was 18% or $43 million higher than the first half of last year. As this graph shows, the higher profit was driven by an increase in net revenue resulting from a higher realised gold price, more than offsetting the lower period-on-period gold production volume. A higher volume of copper sales more than offset the lower copper price period-on-period. Newcrest revenue continues to be overwhelmingly attributable to gold, being 83% of net sales revenue in the December half. Operating costs were a net $21 million higher, primarily due to the addition of Red Chris's operating costs in the period. The weaker Australian dollar had a positive impact on our costs. Depreciation expense was lower in the current period compared to the prior period, reflecting lower production volumes, together with the benefit of the weaker Australian dollar against the US dollar. Of the increase in costs associated with corporate and other, $16 million of this relates to our equity accounted share of losses in associates, with the balance reflecting a high level of exploration, growth and innovation activities. The increase in tax expense you see is broadly in line with the increase in profitability, with our effective tax rate being 32%, 2% above the corporate tax rate, primarily as a result of non-deductible international exploration expenditures. Turning now to free cash flow. Our free cash flow for this half was negative $729 million, which, as we're highlighting in this slide, reflects our large investment in growth during the period. $774 million was the payment for the acquisition of the interest in Red Chris, and an additional $61 million was invested in Lundin Gold, taking our ownership to 32%. If we adjust for these two expenditures, Newcrest's free cash flow would have otherwise have been a positive $106 million for the half. In total, Newcrest has generated $3.4 billion of free cash flow over the last 6 years, which is a great reflection of the efforts of our people, the quality of our assets, and our focus on safely maximising cash generation. Our strong free cash flow and debt reduction over many years has placed us well within our financial policy metrics. Our leverage ratio of 0.8 times remains comfortably below our target of less than 2 times. Our gearing ratio of 15% at the end of December is well below our target of 25%. Our strong cash position sees our liquidity coverage at $2.7 billion, $2 billion of which consists of committed undrawn bank facilities. And we continue to retain our investment-grade credit rating, which ensures that we have good access to all capital markets. With that, I'll hand back to Sandeep.
Thanks, Gerard. I'll now highlight what makes Newcrest unique as a multi-decade gold copper miner. Newcrest's portfolio comprises some long-life producing mines and the industry's leading low-cost mine in Cadia. We have some development projects with long lives and attractive returns. And now we also have a portfolio of exploration opportunities that are delivering some exciting results. Our asset mix makes Newcrest unique in the gold industry. With Cadia and Lihir, we have the two largest operating mines by reserve base in our peer group, and by a considerable margin, as you can see from this graph. Amongst our gold major peer group of Newmont and Barrick, Cadia and Lihir are the only two operating assets with more than 15 million ounces of gold reserves. This large gold endowment means that Newcrest is one of the longest reserve lives in the industry. In fact, we have around 25 years of mine life at Cadia and Lihir alone, based on reserves. This is a unique attribute that none of our peers have. However, we're not complacent and are focused on a number of meaningful organic growth projects. During the half, we gated stage 1 of the Cadia expansion project to execution. The first stage comprises the development of the next cave, Panel Cave 2-3, and an increase in the nameplate capacity of the process plant to 33 million tonnes per annum. The second stage, which is now in feasibility study, is focused on a further increase in processing capacity to 35 million tonnes per annum and improving recovery rates. This represents a 17% increase on Cadia's current 30 million tonnes per annum annual rate. Combined, the two stages are estimated to have a total capital cost of $865 million. Cadia is one of the world's premier gold assets, and it has the potential to be delivering gold and copper at a low cost for decades to come. As I mentioned earlier, during the half, Lihir commenced transition to a biannual shutdown strategy aimed at improving equipment utilisation and reliability from FY21 onwards. Previously, Lihir's maintenance schedule resulted in roughly 130 days of interruption throughout the year. During FY20, we are making the transition to two shutdowns in March and September of each year. We expect that this transition will halve the number of days impacted by planned major maintenance. I have long stated that realising the full potential of Lihir is dependent on increasing the uptime of the plant, and this is one of the many strategies we're employing to achieve that. The price for getting it right is substantial. Now turning to our exploration portfolio. The latest drilling results continue to expand the gold-copper mineralisation at the Havieron project, located 45 kilometres east of Telfer. I refer you to our recently released drill results, and I think you'll share our enthusiasm. In fact, these results have encouraged us to increase our FY20 exploration expenditure guidance range by $25 million. We plan to drill an additional 20 to 30,000 metres in the second half of the year to support the potential delivery of a resource by the end of calendar year 2020. Finding gold is hard and rare, so to get these kind of drilling results is really exciting. In the same exploration report, we announced the positive initial drill results for the Newcrest mine in Canada. These drill results have identified a new, higher-grade area in the Gully Zone. The known Gully Zone mineralisation has been expanded at depths between 500 metres and 1,000 metres below surface, including high-grade intercepts as disclosed in the exploration report. Additional drilling at the Gully Zone is planned to map the extent of the high-grade mineralisation and will underpin the assessment of the viability of an additional block cave. In the East Zone, under the existing open pit, we've commenced the East Zone Resource Definition Program. Our intention is to develop a new resource model incorporating both historical imperial metals and Newcrest drilling data. Newcrest aligns with our strategic capability to find, build and operate large-scale underground mines. Beyond expanding our existing mines, we have a number of high-return development projects within our portfolio. Newcrest owns 50% of the Wafi-Golpu project, which is one of the premier undeveloped gold-copper projects in the world. Earlier this week, the judicial review proceeding between the Governor of the Morobe province and the state of PNG in relation to the Wafi-Golpu MOU was dismissed by the National Court. As a consequence, the stay order restricting the joint venture from engaging in discussions with the state of PNG has now been lifted. We see this as a positive development, and we look forward to recommencing these discussions with the government. Wafi-Golpu has the potential to become a Tier 1 operation, a multi-decade mine with a low cost of production, producing on average approximately 266,000 ounces of gold and 160,000 tonnes of copper a year. In times of uncertainty, the gold industry has historically provided a safe haven for investors. This has proven true over the last year, with the average gold price increasing by 18% in 2019, and it has continued to strengthen in 2020. We believe that Newcrest has 6 competitive advantages that set us apart in the gold industry. One is our unique long reserve life. Our long life assets mean we can continue to produce for decades to come. Second, our low cost production, because having a lot of gold won't create value unless you can achieve strong margins from its extraction. We remain the lowest cost major gold producer, with our all-in sustaining cost positioned in the first quartile. Third, we do what we say. We have a strong track record of achieving our guidance and delivering on our plans. We also have a multitude of growth options, and we have strong technical and exploration capabilities. And finally, we're focused on remaining financially robust. Combined, these elements make Newcrest a unique offering in the gold industry. With that, I'll open up the line to questions.
Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question today, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request at any time, please press the # or # key. Your first question today comes from the line of Stuart McIntyre from Blue Ocean Equity. Please go ahead.
Thank you. Hi guys. Listen, my first question is about Lihir. Lihir produced 382,000 ounces in the first half, but obviously needs a strong second half and a 44% increase in production to meet the bottom end of guidance. Should we expect to see materially higher grades at Lihir in the second half?
Well, I think as I touched on, we got lower grades and tonnes out of principally Phase 14. So in the first quarter, we saw Phase 9 come to an end. Previously, we were drawing from 9 and 14, and we're now transitioning to opening up 15. So in that interim, we got less than we expected out of Phase 14. It has a lot of narrow benches in it, so we've now changed our some of the mining methods there, our blasting practices. So we are seeing higher grades and higher sulphur in particular also coming from Phase 14. So we do expect higher grades in the second half than the first half. Okay,
excellent. I mean, even if I run through, I guess, the record throughput that you've done at Lihir to date, I still sort of need to run 2.7 grams in that second half to meet guidance. And I guess I was just also looking at that, the shutdown schedule that you provided, and it looks like you're sort of streamlining that in FY21 to ensure the shutdowns sort of overlap as much as possible to minimise the downtime. But it does look like the second half of FY20 still has shutdowns in 4 of the 6 months. Is that right? Can you talk a little bit about the impact of shutdowns in the second half? You don't expect that to have too much of an impact on throughput?
Well, part of the reason for doing what we did in the first half is we will have another shutdown in the second half, but in line with our new strategy, that'll happen sort of towards the end of March, early April, something like that. But that's with the new kind of shutdown where we do more work in a compressed period as opposed to doing multiple jobs in different shutdowns over the course of many months. So we've effectively moved to that new strategy already.
Oh, okay. So that is implemented from now. Okay.
Yeah, and the first half was the transition.
Okay, understood. And look, just finally, at Wafi-Golpu, in the last study you guys put out, you indicated that project's probably going to take around 4.75 years to produce first gold from the grant of the SML. Now, earlier this week, the injunction at Wafi was lifted. Can you please talk us through the steps required from here to obtain the SML? And if possible, your views on the likely timetable?
Look, in terms of the steps, what we can do now is, and we were well advanced on the EIS and many other approvals, so that can all restart now because the bureaucrats in the government can now re-engage on that. I mean, they weren't allowed to because of the injunction. And at the higher level, we have to sit down with the new government and hammer out a new agreement, a development agreement, and all those things in parallel then combine to form the basis for the granting of an SML.
Okay, I mean,
we look. We now enter a period where we can re-engage. If you look at the public remarks from the Prime Minister, he's come out and said that Wafi-Golpu is now one of his priorities, particularly now that it looks like the oil and gas projects have ended a little bit of a hiatus. So we're encouraged to hear that, but as always, whatever deal we hammer out's got to work for both parties, and that's what we're focused on. It's got to be a win-win agreement.
Okay, understood. So I guess it's still pretty hard for us all to forecast what the likely timetable on that is.
It is. I've sort of given up forecasting it. I think it is encouraging that we're engaging, and as soon as there's something to report, we'll report.
Understood. Thank you very much.
Your next question comes from the line of Daniel Morgan from UBS. Please go ahead.
Hi there, Sandeep. One of your themes in your presentation, and I guess for the last few months, has been exploration focus at Redcrest and also Havieron. I think in the past you've talked about what you want to get to a position of is, have you seen enough in order to put down an exploration decline and get down there and really see out drill laterally? Just wondering how closer we are, if at all, to that decision on either asset.
Well, we obviously got to do a lot more drilling. I mean, the last thing you want to do is put a decline in the wrong place. So there's a certain amount of drilling that has to be done to make sure you position it right. But all the necessary approvals processes, the gathering of environmental baseline data, all the things that you would need before applying for permits in both locations, all that work has begun. So we're anticipating that as soon as we get enough drill results to work out where to position these declines, and we can get approval of them from the two regulators, would be a position to get going. And look, we'll have to see what the future drill results indicate. But if you look at the ones we've got so far, we're feeling pretty confident.
Thank you. And just one more, just to follow up, I guess, on the Wafi-Golpu news and the ability to re-engage. It seemed like you had a very much a shovel-ready project, a project team that was set to go, and obviously it was disappointing to see that have to get put on hold. What, if any, I guess, how quickly could you redeploy a project team once you get a SML?
Look, it's a good question. I think we can do it fairly quickly. We've retained a number of those personnel inside our company and also within Harmony. And the other thing is, this is a great project. I mean, once the SML is actually agreed and people know it's certain, I have no doubt we'll get a whole bunch of people who want to come and deliver this thing. It's a great project. It's a great ore body.
Thank you very much.
Your next question comes from the line of Levi Spry from JP Morgan. Please go ahead.
Thanks, guys. Questions are going to be on the same areas. So up at Telfer, can you map out the path forward there for us? So how do we avoid a production hiatus there in between current reserves and bringing on Havieron?
Well, I mean, the first step is obviously taking a lot of the unit cost out of Telfer in the existing mine to make it more profitable on the reserves it's got left, depending how low that becomes. I mean, there are options for a couple more cutbacks on the surface, which we haven't committed to at this point. There's also some potential for maybe even extending the underground life by some exploration we're doing there, which may reveal some smaller deposits, but stuff that you can do through incremental mining. And the other piece, as you say, is how do we bring Havieron on as soon as we possibly can. Now, it depends what sort of mining we're looking at. I mean, if you're looking at the grades there, I mean, again, we've got to do a lot more drilling. But if that becomes potentially a high-grade mine, you could bring that on sooner rather than later and then bulk it out later. Or if you go to bulk initially, it'll take a little bit longer. There's all sorts of options we can play. But if we just continue and we continue to find quite high-grade amongst the lower-grade kind of stockwork, if that trend continues, and we'll see, then they are the various levers we have to pull to try and prevent a hiatus.
So any of them being studied right now? So cutbacks, are there pre-feasibility studies going on that kind of stuff? I understand you've got to drill, have you on for probably a couple of years before you can commit to something. By then your reserve base will be exhausted. So what's underway right now other than drilling?
All those things I touched upon are work in progress in terms of studies, data gathering, etc.
Okay, and just back in Wafi-Golpu, so SML 5 years, and all the data that we've had previously still stands. So Harmony's sort of recently made a strategic move back in South Africa. Is there any update on your expectations on equity share going forward with yourselves?
Oh, look, there's no change in my view, but I mean, you'd have to talk to Harmony to see what their view is. But certainly, we've been in lockstep and working closely together, for many years now, and I don't see, I haven't heard any reason why that would change, but best ask Harmony.
Okay, thank you.
Just a reminder, ladies and gentlemen, if you do wish to ask a question today, please press star 1. Thank you. Your next question comes from the line of Daniel Morgan from UBS. Please go ahead.
Hi, Sandeep. Everyone's just a little shy or on other calls as well. But just wondering on Fruta del Norte. It's a little bit of a sleeper asset in the portfolio in that, it's about to enter production and commercial production. You've increased your stake to 32%. Just wondering about how you are thinking about getting the market to appropriately value this asset. I think you were flagging you were going to incorporate guidance in group-wide guidance for your equity share, or can you just talk to that?
Yeah, certainly that's the intention, and then we expect to see some recognition for that because it is a Tier 1 mine with a long life, and we have a major stake in it, and so that's still the plan.
Okay, thank you.
Your next question comes from the line of Adam Baker from Global Mining Research. Please go ahead.
Good morning, Sandeep. It's actually Dave Ratcliffe here. My question is, look, some of your peers have obviously started to lift their economic assumptions for reserves and resources. I'm just wondering if there was any consideration when you were going through the process to change yours, and specifically, obviously it doesn't have a large impact on, or a meaningful impact on a number of the key low-cost assets, but with respect and following up to Levi's question on Telfer, where I imagine something closer to today's prices obviously would have quite a material impact, especially because I guess reserves are sort of 1.2 million ounces, yet resources are 2.9 when we're talking about the open pit material. So in today's environment, surely there is some upside to pushing out that open pit material at Telfer.
Look, it's a very good question. I mean, we kind of shy away from changing long-term assumptions like reserves and resources, but when you get down to the detailed technical mine planning and decision-making on a quarterly, monthly, weekly basis, we clearly look at all the ore shells and make value-add adjustments as to what we mine and don't mine on that shorter-term interval.
Okay, so just again, following up, I guess, to Telfer and trying to explain so we all understand, what is the key impediment to pushing out the open pits there? Is it, even at today's price, you don't think, it could be economic? Is the pre-strip too much? I know in the past you've used hedging to try and lock in some of those margins.
Look, it'll all be the economics. I mean, what we'd like to see is the actual operating costs come down in the open pit to a point where we think it's well run. And then once we know what that number is, that gives us a better determination as to whether we can make some money out of any future potential cutbacks that are not committed to.
Okay, thank you.
Your next question comes from the line of Matthew Friedman from Goldman Sachs. Please go ahead.
Thanks. Morning, Sandeep. Just a few quick ones from me, please. Firstly, your progress so far on undercutless caving trials at Telfer. If you could give us a quick update on that, and just wondering how you might expect to feed that into the development of future panels at Cadia in particular. How can we expect the timeline on that study to play out?
Look, if you remember, the Telfer was like a proof of concept trial, and we've done 75% of the work there, and it's gone really well. I was there last week underground, had a good look at it. That's gone really well. So what we'll do now is move the trial, once this finishes Telfer, we'll move it to Cadia itself and test out other aspects of converting a proof of concept into, I guess, something that's battle ready. And then we'll consider implementing that. Best case would be in part of the PC23 footprint, maybe towards the end of as we expand that footprint, or the next cave. That we've got to work out. But the key next step is the Cadia trial, which will be more comprehensive and test out a number of other things. But the first trial at Telfer has gone really well.
Sure, thanks. And maybe just then touching on Cadia, I just noticed flicking through your briefing book that you've kind of retained that view of gold grades tracking around the 1 gram a tonne over the 3-year outlook period. But clearly, in the last half or so, you've probably been tracking close to that 1.2 grams a tonne, so 15 or 20% above that. When might we expect a transition to a more normalised or a lower gold grade around that 1 gram a tonne? And I guess is the higher grades you've been experienced, is that being driven by a preferential drawdown of PC2 versus PC1?
It's there's no doubt PC2 forms the majority of the mix now, and that has a higher grade than what's in PC1 now. But those 3-year averages, you'll see that. I mean, they are 3-year averages. You'll see the trend to lower gold grades unfolding over those periods as we head down towards the long-term reserve grade of the mine.
Sure, so still comfortable with that.
But the expansion is meant to dovetail in with that to start getting the tonnes up as well to help offset some of that decline.
Understand. And I guess just finally, can you give us a reminder on when we might see an updated study on the Lihir seepage barrier?
It's in feasibility study now, and part of that is actually doing a trial excavation and seawall to test things like the concrete mix that gets put in, what temperatures we're going to deal with, and what have you. It's very important to get that bit right, and then once we have that, we'll be in a position to give an update on the feasibility.
Okay, so potentially this calendar year at some stage?
No, it's probably early next year. We don't need this thing for a few years now, but it'll be next calendar year, I'd say.
Okay, sure. Thanks for the details, Sandeep.
Just another reminder, ladies and gentlemen, if you do wish to ask a question today, please press star 1. Thank you. There are no further questions at this time. I would like to hand the conference back to today's presenters. Please continue.
All right, everybody, thank you very much for your time and questions today. And with that, we'll wrap up the conference call. Thank you very much.